It is now my pleasure to turn today's program over to Corey Hardy, Portfolio Specialist from ClearBridge Investments. Sir, the floor is yours.
Great. Thank you, Michelle, and good afternoon, everyone. Welcome to the Aggressive Growth and Multi-Cap Growth Update Conference Call. Again, my name is Corey Hardy. I'm a member of the Portfolio Specialist team here at ClearBridge Investments, and I'll be your host for today's call. Joining me, I have the co-portfolio managers of the Aggressive Growth Fund and the Multi-Cap Growth Separately Managed Account, Richie Freeman and Evan Bauman. Richie has over 40 years investment industry experience, and he's been managing both the fund and the separately managed account since their inception. Joining him is his partner and colleague, Evan Bauman, who has over 20 years investment industry experience and has been working with Richie as a co-manager on the funds and the SMA for 15 years. As a quick refresher on the strategy, Richie and Evan strive to deliver authentic active management through meaningful investments in a concentrated number of companies that they believe will exhibit strong growth characteristics over a long term. The result is a high active share, high conviction, low turnover portfolio that they feel will generate returns that are very differentiated from the benchmark. Today, Richie's going to kick off the conference call by providing some thoughts surrounding the challenges and opportunities of the current market, and Evan's going to provide an update on the portfolio's current positioning as well as an outlook for the strategy. After their prepared remarks, we'll move to a Q&A format. We do have a couple questions already queued up for the PMs to answer, so thank you to all of you who submitted questions in advance to give us a direction for today's call. We really do appreciate that. Please keep in mind, however, that if you have not submitted questions to this point, we invite you to do so and submit them through our web-based platform, and we'll try to get through as many of those as we can over the next hour or so. With that, I'm going to pause there and turn it over to Richie for his outlook on both the market and the portfolio.
Corey, thanks very much, and I'm going to quote Mel Allen. Hello, everybody. It's always great to do these calls. We've been doing them roughly. We try to keep it on a quarterly basis, and I always try to do, I ask for the transcript of the prior calls to see if the parameters that we're using back then are still valid right now, and surprisingly, very little has changed from what we laid out back when we did the December call. If you remember at that time, I said that we thought that the market was making a major bottom. Actually, we thought it did it in November. Didn't see the 1,500-point implosion after that, which was Fed-related. But ironically, it was the Fed's last hike of interest rates which caused that decline, which is sowing the seeds of this powerful bull market. And the market, I think, because the Fed raised rates back in December, is probably going to lead to a stronger recovery, stronger rally, much stronger bull market than otherwise would have been, because for the first time now in probably a decade, the Fed has indicated that they might actually be cutting rates. Also indicated back then, and I think it's very, very valid to say, that stock markets tend to bottom every 4 years in powerful bottoms. I cited the bottom that we saw back in 62, 66, 70. You just keep enhancing that roughly every 4 years. And it happens in the presidential election cycle. I think it's very, very valid. And depending on the psychology of the investor going into that, you can either have a modest rally, 30%, or you can have one that's substantially more than that. But I've read numbers that coming off one of those 4-year bottoms, this is the only cycle that I actually talk about because it's worked for the last 50 years. It works until it doesn't work. But coming off of that, you tend to get rallies that sometimes are as much as 50%, and you've never had one that's been less than 30%. That's all well and good. It's what you own that's going to be most important. So I looked at back what we said in April, and we talked about the valuation, the relative valuation of the portfolio compared to the market, because there's always, understandably, a lot of concern about, what is your benchmark doing? Do you hug a benchmark? Why don't you own some names? Why are you owning certain names? I do not remember a time, I've mentioned back in April, where the valuation of the portfolio compared to the market, and that's the one time I'll talk about compared to the market, was as relatively attractive as it was back, I'd have to go back maybe to the 1996 period, or maybe back at the beginning of 2003, which will not guarantee that we're going to do well, but it tells me from a starting point, I think the risk-reward is significantly in our favor. And the one thing I remember saying was, and Tom Sharp cited me on this one, I didn't remember a time when we had more potential companies in the portfolio that had the potential to rally between 50 and 100%, which sounds rather outlandish. But if you take a look at the starting points of valuations, I really don't think it's that crazy. And We did the call probably right after Anadarko got a bid made by Chevron for them. Anadarko was trading in the 40s. Chevron made a bid in the 60s. It was eventually upped and accepted when Occidental Petroleum made a bid in the 70s. So for a stock that was languishing, they became monetized, and a lot of the performance happened all at once. Another name that we've seen also was Allergan, which has seen Allergan was lagging poorly until AbbVie came along and monetized it. We never know if our companies will be acquired, but we've always said the probabilities will increase that you will have acquisitions in your portfolio if companies are selling at 10 times earnings or less, throwing off a lot of free cash flow, buying back stock, reinvesting in business. And stocks, a lot of times when you own them, there's almost a feeling of despondency. Why aren't these stocks doing well? The street has to know something. Why is Allergan at 115? There has to be some kind of problem. Why is Anadarko at 46? Clearly, there's something wrong. But a lot of other companies, they don't care what the investors think if they can take advantage of it. And in that case, Occidental as well as AbbVie, did take advantage of it in the process of acquiring them. The scenario that we have right now in the market, I think, is why it's still conducive to being a powerful bull market. Is you're at a point right now where the market is almost forgiving cyclical companies that are going through earnings pressure, because you're looking towards the other side. If the Fed were not indicating that they would be lowering interest rates, that would be a different story. But you've seen it now with some of the storage companies, some of the semiconductor and memory companies that have been missing expectations, yet the stocks have been very, very resilient. That's a hallmark of a powerful bull market, because on the other side of that, when rates are lowered, and rates are going to be lowered per what the Federal Reserve has said, then you start to improve business conditions, and you start to see the other side of it with earnings estimates eventually rising. So that's why markets like this usually don't peter out in 6 months. They tend to last really for a couple of years or so. So that's the underpinning of how we feel. I don't think that the valuation of the stock market right now, even though the S&P is at 3,000, which is at an all-time high, I don't sense that the overall valuation is anywhere near as egregious as it was back in 2000. We've got a lot of questions. Do you think there's a bubble? I think valuations are far from that. However, there's an amazing dichotomy between valuations of companies that sell at 6, 7, 8 times earnings, 9 times earnings, and other companies that are selling at multi-$100 billion market caps. I mean, clearly they're great companies, but eventually you reach a limit as to what a company should be valued at versus its cash flow, et cetera. And I'd rather go to sleep owning companies that are selling at 6, 7, 8 times cash flow, where we can have an upward readjustment of valuation, where companies are, I'll call them out of favor in the stock market, and companies are taking advantage of it. To me, I think that's a tried and true traditional way to make money in the stock market. Short term, I can't tell you what they do, and that's exactly what I said back in April. We can't tell you where the next 10 or 20% move in the stock will be. But if you're starting from valuation points, and we saw it, a good example today was Biogen, which was a very crowded passive long, if you want to talk statistics. Very few active managers have owned this stock. It's been sold down. It's clearly been disappointing with their Alzheimer's failure this year. If you get down to a level where you're trading at 7 times earnings, buying back your own stock, it doesn't take much of a positive surprise to see an upward revaluation in a name like that. And it's not just Biogen. You can go down. There's a myriad of companies that we have. So that's part and parcel. Evan can talk about the numbers. He has some great statistics. But net, I think the bull market is clearly underway. I think it's a powerful bull market. The best thing would be if we have periodic 5-8% corrections. We had one a couple of months ago. They tend to perpetuate a bull market as opposed to terminate them. You'll know it's over when you have over 65% of stock market letter writers bullish. Traditionally, euphoria tends to end bull markets with a little bit of a lag. You're not near those levels right now. I think there are some crowded trades that I think could be subject to some meaningful declines, but we feel very, 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 very good. I feel great about the overall position of this portfolio. So, Evan, why don't you take over the reins now?
Yeah, thanks. Sticking with the Mel Allen Yankees theme, I guess I'm Mickey to your Yogi. But as the new kid, only here 25 years. But I think what Richie talked about is important to just review a few of the points. I think when we joke about how long we've been doing this, and legitimately, I think, when you look at a strategy that's been around since 1983 with a very consistent team, very few managers have been doing this as long as Richie and have a junior guy who's been part of the team for over 20 years with a consistent process and philosophy and a product philosophy which has worked in all different markets in terms of growing client assets and building wealth. For newer clients particularly, it's important to review a little bit the process and speak about how we manage money, what makes us so different from many more traditional style box pure or benchmark sensitive growth funds and strategies and SMAs today, where we really do think of ourselves as long-term business owners. I mean, Richie made reference to a number of companies, some are which are involved in M&A and some of which are companies which are larger cap in nature today, established companies with profitability like Biogen that we've owned for decades. We've owned for over, in that case, 27 years. And I think in today's environment, which is, we always speak about the short-term nature of the trading environment today, the idea, what have you done for me lately in terms of performance and what's the next great stock for tomorrow? I think when we look at the way that we've built client wealth over the long term, it's really consistent today with the way that it was done years ago. It's focusing on innovation, focusing on business models that have the ability to generate meaningful amounts of free cash flow and grow the cash on a durable, sustainable basis. We're looking for intangibles like IP and patents and companies that are in many cases, and again, we'll talk in specifics about today's environment, but I think we're really looking for mispriced companies in the public markets, companies that can be monetized over time, the way some of our names have been, buying them small and mid and riding them into the later, larger stages of growth, or by other companies. And I think one of the big themes Richie touched upon, Allergan and Anadarko, is as important to today, and I'm sure there are questions about those deals, and we'll hopefully hit on that. But the fact that since 1996, we've had about 80 companies acquired, so almost 4 per year on average in the portfolio. It's not that we seek out companies to be acquired, but when you look at environments like today where you have not just undervalued businesses in areas like healthcare, media, non-FANG tech, and obviously what's happening in energy, you have undervalued businesses generating a lot of cash with cash on balance sheet where you also have growth. And I think one of the things that gets lost with a strategy like ours, particularly over the last couple of years, newer clients look at multi-cap growth or the aggressive growth strategy and they say, well, you guys are core-ish or you're value managers. And I think when you have to think about how we define ourselves, we are truly growth managers. We're long-term, looking for long-term business models that can stand the test of time with big addressable markets at their behest, where they have unique products and services that change the way medicine is prescribed or the way that products are used that are disruptive. We're just looking not to overpay for them. So I think what's interesting and important to frame today's discussion is you have a lot of the growth universe that is really undervalued today. It's not that we're owning necessarily traditional value areas like banks or autos. We're owning companies that are across the board, on average, growing double digits that happen to be trading today in many cases at single-digit or low double-digit multiples of earnings, trading at big free cash flow yields, trading actually at dividend yields that today are higher than the market, something we never focused on. And obviously, I think what's happening in areas like healthcare and media, which are 2 key important areas where we have overweights, is indicative of longer-term trends where larger companies which are generating cash, which many of them themselves are trading at discounts to history, are looking to the stock market right now as a means of accreting growth over the long term, buying companies, trading it at multiples which are equal or less than themselves, which gives them the ability to extend the runway of cash flow. That's what's happening with the AbbVie Allergan proposed deal. I think that's what's happening in the energy complex around the exploration space. And longer term, I think that's an important trend that's happening. Richie mentioned that we're at an S&P right now that's within a short putt of all-time highs. The multiple on the S&P is certainly not near or close to bubble levels. Sentiment is still very negative in most of the market. You speak to executives and boards in areas like energy and healthcare, and they'll tell you that the political rhetoric and in some cases the headline risk in areas like energy have suppressed multiples significantly, to the point where the best way to create value for shareholders is through buybacks. It's through reinvesting in the business. But if there's a bid out there, and I know we'll get into more of the M&A discussion moving forward, but if you have a real bid at a 40 or a 60% premium, it's certainly worth considering. And I think that's what's starting to happen in certain areas of the market. And what Richie and I spend the majority of our time doing is, engaging with managements, with in some cases boards, and saying, what can we do in an environment where we're not getting paid for the growth that you're delivering? Are there things that can be done? And I think you're going to see more creative type deals. I think you're going to see a lot more M&A. Even after these deals, it wouldn't be unlikely to see more and more consolidation in certain areas, because frankly, the market is, at this point, the overall stock market, it's similar, as you said, Rich. It's not the 90s in terms of an asset, a true traditional asset or valuation or sentiment bubble, but you certainly have crowding. You have, I think, a lot of growth managers feeling more and more pressure to own fewer and fewer stocks that are dominant in the indices. Remember, we're at a point right now where the growth indices have a third of their assets in 10 stocks, a quarter of their assets in 4 and 5 stocks. And that, to me, is a case where you have a lot of stocks where there's complacency, there's crowding, and then you have a lot of the market that's really mispriced right now. And our sense is, and this is an important point just to finish on, and then we'll go to Corey for questions. We always say to ourselves, if we were starting a portfolio today, what would we buy? And importantly, the answer is these companies at these multiples with this type of growth in the areas that we own. If we were doing this for ourselves, what would we do? And I think we always make the point that our single largest personal at-risk investment is this strategy. And we wouldn't do anything differently for ourselves than we're doing for you as the clients. So, I started out by talking about consistency. Look, results of a portfolio that manage with this type of active share that's 96%, the results are not linear. The results are really not correlated to traditional growth strategies. But I think 35, 36 years is a pretty good testing period. You've been through every type of market environment, including the most recent 5 years, which have been disappointing on a relative basis, even though we've made money for clients. If history is any indicator, ultimately the reversion to the mean in terms of multiples, the reversion to the mean caused by consolidation in certain areas is in the early days of starting to occur. And as we always say, look, we feel good about what we own, as Richie said. Right now, point in time today, we probably feel better about what we own, just given where the statistics and the characteristics look, than any point in the recent history. And let's get into some of the detail on the what and whys of some of that background.
Great. So sticking with the M&A theme, both Richie and Evan touched on M&A in their prepared comments. But as you mentioned, some of these names are depressed, like an Anadarko, for example, when that bid comes in. So how do the two of you decide what's a fair price for a company to pay for a stock like that in the public market when you think the private valuation is deeply discounted? And then as a follow-on question, we've got this through the portal. One of the questions was around how do you guys decide whether to own or sell the acquiring company when you do see that M&A activity happen. So if you could touch on both of those, sticking with that M&A theme, I think the listeners would appreciate it.
Yeah, it's Evan. I'll take the first crack just because I'm warmed up. I think there's good M&A and there's bad M&A. I think the M&A is a byproduct of everything we described in terms of the process. We're not publicly speaking about our investments. We're speaking to you, the clients. We're not going on TV and saying a company should sell itself. We're not buying an investment with the short-term hope that they get sold. I think it really is where if you buy companies early and you buy them when you feel like the public markets are misvaluing the cash flow streams, then other companies, and you buy good IP and you buy good forward-looking managements with balance sheet strength, other companies should be targeting those same types of characteristics. And we've had periods, you look at a period like 2012 to 2014, I think we had 10 deals, 10 takeovers in a very tight period in less than 3 years. We've had other years, in the market post-tax reform, you didn't have a lot of takeovers. So we had some smaller deals, but we didn't, the market itself really wasn't going through a lot of M&A. More companies were doing buybacks than M&A. But I think if you look at the history, I think there are definitely cases where you get full value for your shares, right? And of course, it depends what the structure of the deal is. Some are cash, some are a combination, like the two most recent deals, and some are all stock, more merger types, where we've held a combined company like a Broadcom Avago deal or a Medtronic Covidien, where our company was really used as the next leg of growth for the acquiring vehicle. Those are certain deals. We get others where we feel like we're getting full value. When Danaher bought Paul Corp, they paid cash, and we thought we had a really good price that they were paying for our assets. So it depends on the deal, Corey. It depends. We look at every deal uniquely, and I think that at the types of multiples the overall portfolio is trading at, I think there are companies that we own where you wouldn't want them to be acquired, even at a reasonable premium. I think there are a number of names, for example, in the media space, where a company trading at a rich multiple that's a streamer, a over-the-top video type service, could buy some of our programmers at twice where they're trading, and it would still be massively accretive to their own cash flow profile. So it's going to be interesting to watch and see what happens. I think in the two deals we discussed earlier, I think as we made reference to, it's a good deal, even at the 40 to 60% premium. These could end up being very good deals for the acquiring company. And I think that in the therapeutic space, for example, in the biotech space, unless we got a meaningful, significant premium, we'd rather see more creative structures in terms of deals. Maybe a company takes an investment in one of our names at a meaningful premium, takes a stock or an equity investment. So, yeah, I think the reality is in areas like energy, you're going to see more deals. It's the only way I think that you start to close the gap, the arbitrage between public and private market values. But I think for us as shareholders who are really looking to create value over the next 10 or 20 years, you don't necessarily always want a deal. The famous one was Chiron in 2006. We had held the name since 1986, and I'll quote Richie to himself, who said, if I don't get full and fair value for all of my shareholders, I'll vote against the deal. And we actually did that publicly and ended up getting a meaningfully higher final price in the deal. So we think long term, and we think about not just making a quick buck, but obviously trying to accrete as much value to us as the shareholder and our clients as is possible.
That's a great point, and the Chiron thing is a great illustration. We call ourselves passive investors. We're not activists. We don't stir the pot. However, and the big however is, if we do have meaningful stakes in companies and we don't agree with the price, we're not afraid to publicly file, the forms, and as we did with Chiron, as we also did with Imclone, if you go back also over a decade ago. But sometimes the price will be so attractive that you have to be crazy not to take it. I remember Saturday afternoon this year, sitting in the Port Washington diner, I saw the rumor coming across that Roche is going to buy Spark Therapeutics at more than twice the price. That to us was a surprise. The price itself was, we thought, terrific, and it wasn't a question: are we going to play arbitrageur to catch the last eighth of a dollar? That was a very, very pleasant surprise, and we took advantage of it. That was a cash deal, which to date still hasn't closed yet. So we're glad we took the money on that.
Great. So healthcare is a huge part of the portfolio, and we've seen some of the deal activity we've been talking about, like the Allergan being taken over by AbbVie for about $63 billion. We've seen that M&A activity there, but a lot of investors are worried that there might be an overhang on healthcare as we enter this U.S. presidential election cycle. So how are the two of you thinking about your healthcare exposure, given those two conflicting themes within that space?
I guess, let me take a first crack at it. There has been concern about healthcare stocks and healthcare earnings I want to say really since 1993 when President Clinton was president and Hillary Clinton was going to revamp the healthcare system. And if you remember at that time, the stock sold off dramatically, and it was a great buying opportunity. And we saw when President Obama won, there was also a lot of concern, is they going to be single payer? Stocks got down to very, very cheap multiples. I remember United Healthcare stock got down, it was probably in the teens at that time before it's moved into the 200s right now. So it clearly does have negative psychological connotations. This time, it seems that both parties are for lowering healthcare costs. I mean, they want to prevent costs from continuing to escalate the way they have been. And in one respect, I think the jawboning that President Trump has been doing has kept price increases down significantly. Price increases on drugs, with a few exceptions, are at the lowest levels that we've seen in quite some time, with the exception of some orphan drugs. And I think companies are afraid to be the one on, the first one out there raising price, being the one to raise a price by 50%. You don't have that anymore. And I think jawboning has succeeded in keeping pricing down. Now, whether he's going to pass anything that's going to be much more draconian, it sort of flies in the face of what he also tried to accomplish, which is to try to get more innovation, to try to get drugs approved earlier. What incentive is there for a company to develop a drug that could cost, in a sense, over $1 billion if that drug is, if you don't have the ability to price it attractively, and if they're going to be clamping down on some of your existing drugs which have been approved, and say you want to lower the price of those drugs 20 or 30%, that would clearly have a very negative impact on a company's earnings, and I think it would be a hindrance to spending more on R&D. So it's really it's sort of an oxymoron. It really runs counter to each other. It's going to have to be a balancing act. What I'd like to see is more jawboning. I think from this point on, if they want to put some kind of a cap on future price increases to inflation or something over that, I think that would be very palatable, and I don't think that would have a very negative impact on future drug activity. But it's very, very important now more than ever when you've had so many terrible diseases, ALS, Alzheimer's, where there are no cures. This would be the exact wrong time to disincentivize people to be spending more on R&D. And the best way to do that is, keep lower prices. I think that runs in the face of exactly opposite of what the administration really longer term would like to accomplish.
Yeah, the only thing I'd add is I think investors are finding every excuse not to own healthcare and every excuse to own tech. And that's where the similarities with the 90s come in. I think you look at the earnings. It's not just cheap. It's I think it's important to talk about. The earnings of these companies remain strong. With Biogen's report today, Allergan had beat a number of quarters in a row before the acquisition, and the market would find every reason to sell the stock and not want to own a name that actually had north of $16 per share of earnings, that was trading at about $115 a share. United Health Group, same thing, incredibly strong. And they've taken years to build up a business that's vertically integrated, that's incredibly scalable and diverse, and is actually part of the solution in bringing down prices to the consumer on a number of fronts, including cost of drugs. But each time they reported, the stock would sell off because of the quote-unquote political risk and the environment around some of their peers who were falling further and further behind UNH in terms of market share and in terms of the diversity of the business. And then what Richie touched upon in terms of unmet needs, there's so many right now in rare disease and neurology and even in cancer still, where you have companies down the small end of the portfolio, some of the very small names that we own, trading at basically the cash on the balance sheet. You have other names like Ionis and Vertex, which are sustainably profitable for the first time in history, versus when we bought them years ago, that are still trading at attractive multiples. And then you have the big names, which if you look at the big companies that are generating a lot of free cash flow, I think it's slide 7 just shows how big the gap has gotten. Slide 5. Between kind of the mid-tier and then the big profitable biotechs that are generating a ton of free cash flow. They're at huge discounts to where they've historically traded vis-a-vis their peers. So you still have big addressable markets out there. As Richie said, FDA, more so than the congressional and the administration talking tough about pricing. FDA is very forward-thinking on innovation and bringing drugs to market sooner in disease progression and in diseases like Alzheimer's, ALS, and Parkinson's by genetically figuring out who might be at risk for these diseases and getting safe, efficacious treatments on the market, and then bringing down prices with more and more generics that impacts much more so the pharma companies that we don't own, which are those that have really been in the market to acquire the innovators. So I think there's a lot of positive things happening, both at the fundamental level. Earnings have been strong. Multiples are compressed. M&A is certainly starting to accelerate. And realistically, scientifically, you're getting areas like gene therapy, where Richie mentioned Spark, which got almost a $5 billion price tag because of the innovation in gene therapy they were providing. That's a big number for a very, very early stage company. So scientifically, there have been a lot of advances, and obviously you're not paying for that in the market right now. But I think a lot of generalists, they're afraid of the headlines. They're afraid of the political environment. We've owned the space for 35 years. It doesn't mean that you get paid tomorrow. But at these types of valuations, I think the risk reward is incredibly compelling in that space.
Richie, Evan, both of you use the word innovation in describing your healthcare holdings. And one of the questions we get pretty frequently, and we're getting on the platform right now, is regarding the FANG holdings, or Facebook, Amazon, Apple, Netflix, and Google. And are we missing out on innovation by not owning those companies in the portfolio? So can you speak a little bit about the portfolio's tech holdings, how you view tech, and how you feel like you're playing some of those trends, like maybe Internet of Things and 5G?
You take it, Evan.
Yeah, I'll start. I mean, I think we are playing them. I think we're just not playing them through the trillion-dollar consumer-facing, big name. And look, those are great companies. I made an important point earlier that this is not the 90s where you had companies at $10, $20 billion market caps that never should have been public, that were out of business 3 months after the NASDAQ crashed. These are great companies. Many of them actually generate meaningful amounts of cash flow, and they're great businesses. I think the point that we're making is underlying those 5 stocks or 6 stocks, there's also some great opportunities within technology supporting a lot of the growth of those companies. Areas like the cloud couldn't grow without Western Digital and Seagate supporting the storage in data centers and nearline storage, which supports the cloud. And yet you were paying 6 times earnings with 6-7% dividend yields earlier this year for a couple of those names, which have risen. Western Digital quietly is up 50+% this year, and it's still trading at less than 10 times mid-cycle earnings. Same with Seagate, is up I think 25 to 30% as well. And you just can't have the growth of the big stuff. Areas like connectivity, where Broadcom and 5G, they're a major player in building out the infrastructure of all these next generation technologies. TE Connectivity and Cree, which are really big beneficiaries of the growth of electric vehicles and the growth of connectors and sensors and content that goes into these vehicles. Broadcom is as well in some of their discrete microprocessors. So it's not that we're averse to tech. It's just that we've made the point for years that I think technology, particularly consumer and internet, they're competitive markets. And I think what you've had recently is so much flow to passive and so much active crowding in these names where if you're a growth portfolio manager and you don't own FANG and you're getting graded versus an index, and those 5 stocks are up again over 30% on average and comprise a quarter of the index, you're probably at this point chasing. You're buying them essentially to neutral weight the holdings there, and we don't necessarily think about what's in the index. We know what's in it. We know what we're getting graded versus, but we have some very good, actually some great technology companies that are not necessarily household names that are supporting, again, the storage, the connectivity, the speech recognition, and a lot of the growth of the backbone of the internet through the the infrastructure space. So it's again, I think when you look at the weighted average cap of our portfolio, we're down around 55 to 65 billion. The index right now is about 300 billion. It just speaks to, while these all might be great companies, I think you have to look at what else is in the market that's not being reflected in terms of the opportunities. And if the market doesn't have to turn on a dime and shift leadership, but if it broadens out beyond the 500 billion to $1 trillion companies, that could be a good flow of funds into some of these areas like mid-cap tech, where there's some good opportunities that are not being fully monetized right now.
So you spoke a little bit about the flow toward passive and how that's creating this crowding into a handful of names. There's a lot of investors out there who will draw the parallel between today and the tech bubble as a result of that crowding being mostly in those big consumer-facing tech companies. Can you speak a little bit about how you think about today versus the late 90s, and if there's anything in the portfolio that you guys are doing to position for that?
Yeah, I had mentioned before that I think there's such an amazing dichotomy, though, between some companies which we think are fully priced and others which are egregiously underpriced. I don't have any sense that it's anywhere near, in total, the same kind of valuation level that you saw back in 2000. At that time, you had Pet.com, et cetera, et cetera. You had companies that were in the new issue market opening up 300 to 500%. With very few exceptions, you don't have that right now. The fact that some of the ride-sharing companies, while they had hyped IPOs, actually traded down afterwards, I actually view that constructively, showing that euphoria is nowhere near what you had back then. So you're always going to have some stocks that are going to be dramatic outperformers. The people that have missed the market are always going to be comparing it to prior tops, hoping that there's a parallel. I don't see it yet. I think you have to have much more euphoria, which you really haven't had yet. I think you have to get multiples significantly higher. You have to get the Fed easing for a more prolonged period of time. And you have to get a period of overvaluation and almost parabolic moves upwards before I think that you can start drawing parallels to back then. It doesn't mean that there aren't some companies that can't go down 40 or 50% that have been heretofore some of the best stocks in the market. It's going to be on us to try to own the ones that we think have the best risk reward. I know you're probably tired of hearing of it, but we've been here before, and we think that I just think it's an overlay in many of our companies. It doesn't make sense to me how a lot of our companies are remaining private, selling at 6, 7, 8 times earnings, throwing off this cash flow, and Wall Street's going to wake up, or somebody's going to monetize them. But I don't see that the strict parallels to 2000 right now.
Yeah, the only thing I'd add is we always say it, but the toughest thing is timing, right? So you can make a lot of money in buying very expensive, even you could have made a ton of money in the bubble if you sold at the right time. What happens with a strategy like ours, it's what we started at the beginning by talking about, is the people, the process, the philosophy of the product being consistent. We're going to do what we do well. And unfortunately, with a strategy like ours, money is typically coming in after periods where our numbers are top across every period, and it comes out after a period like the last few years where on a relative basis we haven't kept up with the index. And I think you are seeing, in March of 2000, nobody, even the most bearish on the tech sector, no one thought the NASDAQ would drop 80%. I think, and again, you only knew in hindsight that you had that type of massive bubble, but we were sticking to our guns. Even with good returns in 98, 99, we were losing, money to the hot dot. And I think what's important to today is you're not going to hear us say, well, things have permanently changed. Now we need to own benchmark companies and we need to manage to an index. If we're right, you'll know in hindsight, then we're going to, produce results in the environment, which is the next 3 to 5 years. And we've given you a few reasons why we think we're in the stages of that starting to swing back towards, some of these undervalued growth areas. But I think that is the key to what we do, is staying consistent to ourselves, a discipline that's worked for 35 years, and not reacting to what's been obviously a very hot growth tape. And a lot of that has been driven by fewer and fewer names. So totally different environment than the 90s. Sentiment is still very negative. Valuations, as Richie said, the S&P is half of where it was back then. We're not saying it's that. It's more a matter of, I think we try to remain consistent to what we do well in terms of owning good undervalued businesses.
I mean, back in 2000, if you remember, NASDAQ had a major crash. We made money for people. Money started flooding in, and then we wound up raising the minimum on our product to try to discourage hot money from coming in because we thought it was, poor timing. We encourage it when we think value. We encourage the money to come in when we think that the risk reward, the valuation of our stuff is egregiously attractive. We try to discourage it if we think it's the other way, and we just thought that the climate was towards us became euphoric as the market itself became very panicky, and we'd rather keep people in to our product when we feel very, very good about it. This is one of these times.
All right, great. And then one final question before we let you guys go. We actually addressed this last time, but I think it's important to go over quickly again because we got it in from the portal a couple of times. But the question was, did you ever own FANG in your portfolio, and if so, when, and when did you exit? And I think that going over this does a good job of highlighting how you two think about buying names in the portfolios.
I would just go ahead, Rich.
No, give him Facebook.
Yeah, I was going to say, we bought a meaningful position in the aggressive growth strategy in Facebook in the fall of 2012. The stock was, and we've gone through this, but it's only 7 years ago. It feels like forever, but that was, at the time, the company was the analogy was MySpace. The media was portraying it as a zero, talking about why social media is a fad, not a trend. We looked at the business, the balance sheet, and the opportunities for growth when the stock was trading in the low 20s on its way down to the mid-teens, and we thought there was great opportunity there. We took stock at 18, and I remember our trader, Lisa Utasi, saying, at 18 you could buy as much as you want because there was so much stock for sale 6 months after the IPO, and there was so much negativity around the business. Well, you flash ahead 5-6 years, and the stock was trading between 150 and 200. It was a top 5 position then for virtually every growth manager, and we took meaningful profits in the name. We've redeployed, as many of you know, a lot of those funds into Twitter, which is still a name which is a fraction of the market cap. It's less than a tenth of the size of Facebook and Amazon, actually a 20th of the size. That has great opportunities, great engagement, and actually accelerating engagement and monetization of the platform in the very early stages of growth, where they're seeing great relationships with a lot of the content providers, like the sports leagues and a lot of the entertainment providers, a lot of the content guys that we talked about in media starting to use Twitter more and more. And that's a name where we still think you're in the early days of growth versus and still it's a very unloved, very underappreciated, and certainly underowned by generalists type of name versus some of the big stuff. So, yeah, we look at them all. Look, we've looked at Apple since the 80s. We've looked at these names. In a lot of cases, we've chosen to own, again, the underlying enabling technologies, the storage, the connectivity, the speech recognition, the backbone of the internet, which benefits any of the providers of consumer devices and growth of tablets and phones as opposed to the consumer company itself. But so, yeah, we're certainly looking at all those types of companies early. We looked at Facebook well before they were public, and again, only bought the name when the valuation and the stock price looked very attractive to us in the fall of 2012. So we'll look at anything. I think the goal is to make money. We talked earlier about, making money without taking undue risk and investing alongside of our shareholders. But, it's just a point in time here in late July where I think a lot of those names are now consensus longs and a lot of the rest of the market is very unloved.
All right, great. So with that, we're getting close to the top of the hour here, so I want to be mindful of everyone's time. I did want to take a second and say thank you very much to everyone who took the time out of their day to dial into today's call. As a quick housekeeping item, I did want to mention that there will be a replay dial-in for this call. And if you're registered for today's call, you'll automatically receive that via an email. But that information will come out to you as soon as it's available. Please feel free to share that with any of your colleagues that maybe didn't have the time to dial into today's call. In addition, if there are any lingering questions that were not answered on today's call, please feel free to reach out to your Legg Mason wholesaler or the ClearBridge specialist team, and we'll be happy to get you whatever you need. So on behalf of Evan, Richie, and myself, I just want to say thank you very much for the partnership, and thank you all for dialing into today's call. Have a great day.